You've saved up some money and you're ready to invest, but everywhere you look it's index funds versus ETFs. It sounds like a financial showdown, but here's the truth. Both are powerful, simple tools for building wealth. Think of it like choosing between an automatic and a manual car. Both get you to financial freedom, but the ride feels different. One is set it and forget it. The other gives you more control. We'll break down what they are, how they work, and which fits your style. No jargon, just what matters for your money. So grab a coffee and let's settle the debate: index fund or ETF. Let's get clear. Index funds and ETFs are both baskets of stocks or bonds, giving you instant diversification. Instead of buying hundreds of individual stocks, you buy one fund and own a piece of all of them. Both are passive investments, aiming to match the market, not beat it. The S&P 500 is the classic example. Buy an S&P 500 index fund or ETF, and your money moves with the market. The real difference? Structure and trading. Index funds are the old-school mutual fund style. ETFs are the modern, flexible version. Same stocks, same returns, just different wrappers. Now let's see what actually sets them apart. Here's the first big difference: how you buy and sell. ETFs trade like stocks. You can buy or sell anytime the market's open, with prices changing by the second. Index funds? You buy or sell once a day, after the market closes, at the fund's end-of-day price. ETFs offer flexibility and instant action. Index funds enforce patience and discipline. If you want to react to market swings, ETFs are your tool. If you want to avoid emotional trading and stick to a plan, index funds have your back. In today's fast-paced world, ask yourself, do you want control or do you want a system that keeps you steady? Your answer points you to the right choice. Fees matter a lot. Both index funds and ETFs are cheap, but let's get specific. The main cost is the expense ratio, often just a few bucks per $10,000 invested. ETFs used to be cheaper, but now index funds from places like Fidelity and Vanguard can be just as low, sometimes even zero. ETFs may have tiny trading costs like the bid-ask spread, but most big ETFs are nearly free to trade. Index funds have no bid-ask spread but often require a higher minimum investment. ETFs let you start with the price of a single share or even less with fractional shares. Bottom line, both are affordable, but ETFs are more accessible for small investors. Choose what fits your budget and style. Taxes can quietly eat into your returns, but ETFs have a structural edge. When lots of people sell an index fund, the fund might have to sell stocks, triggering capital gains taxes for everyone. ETFs use a clever in-kind process, so they rarely trigger these taxes, making them more tax efficient in regular brokerage accounts. But if you're investing in a 401k or IRA, taxes aren't an issue. Both options grow tax-free or tax-deferred. So for retirement accounts, it's a tie. For taxable accounts, ETFs usually win on taxes. Know where your money is going and pick accordingly. Let's see this in action with Sarah and Tom, both investing $10,000 in the S&P 500. Sarah picks the Vanguard Index Fund, VFIX, meets the minimum, and buys at the end-of-day price. She sets up automatic monthly investments, hands-off, simple and disciplined. Tom chooses the ETF, VUO, buys instantly at the current price and can trade anytime. He can invest any amount, even with fractional shares, but has to log in each time to buy more. Sarah's approach is all about automation and ignoring daily market noise. Tom's is about flexibility and control. Both get nearly identical returns, but the experience is different. Sarah's method is perfect for passive investors. Tom's suits those who want to be hands-on. Pick the path that matches your personality. So index fund or ETF? The best choice depends on you. ETFs are great if you want flexibility, intraday trading and tax efficiency in a regular account. They're also super accessible. Start with just a few bucks. Index funds are ideal if you want to automate everything and avoid emotional decisions. They make consistent passive investing easy. Both are excellent for building wealth. The key is to start. You can even use both index funds in your 401k, ETFs in your brokerage account. What's your pick for 2025? Let us know in the comments.